sold the idea that financial independence is all about some number on your account statement, or even worse, that you don't qualify because of where you started out. That's just not true. It's not about some well-kept secret of the wealthy. It's about finding the right information and knowing how to apply it. On the Get Ready for the Future show, we're answering your questions so you can start making real financial change today. The journey to true financial independence begins right here, and it starts with you.
The one show that is focused on your financial independence is on the air. Welcome to the Get Ready for the Future show. I'm John Shrewsbury. Joining me today from our Conway office is Teresa Arago. Been a while since we've been on the radio together.
It has been. I think, Talking Sense is on there every week, but we don't get to work together. So I'm excited to be here with you today.
Yeah, vacation schedules, sabbatical schedules, all that type of thing.
Basically, he's saying I'm not first string. I'm like last resort, but it's fine. I'm
well,
used to it.
it's quite all right. You do quite well. So we've got lots of questions that we've got teed up for you today on the Get Ready for the Future show. Everything focused on helping you to succeed financially. Financial independence is our goal here at the Get Ready for the Future show and at GenWealth Financial Advisors, and we want to focus you on the details of how to get there. So let's go ahead and get started right off the bat with Jim from Rogers, who has a question for us today. Jim writes, my wife and I, 60 and 58, have a stereotypical 60-40 split. Based on the 100 minus your age rule, we would be considered overweight in stocks. Our total net worth is around $3.2 million. Should we be worried about a market downturn? Are we safe enough? Jim from Rogers, thank you very much for that question. Teresa, this is the quintessential question that happens, almost every time we sit down with a client. Am I okay? Yes. Am I too risky? Am I going to make it in retirement? So what do we say to Jim here? And let's particularly talk about this 100 minus your age thing.
To me, I think these sorts of things can be a little misleading, but the way that rule works is you take the number 100 less your age, and that's how much stock exposure you should have. So for instance, I'm about to turn 45, so that would indicate that I could have up to 55% stock exposure. That feels to me very low.
Yes.
Which is my concern with it. I think the assumption is that if you want to be safe, that you're going to need every dollar immediately day one of retirement, which isn't typically the case. You want to make sure that you have a strategy, not just some, ambiguous, ununique advice. I can't come up with the right word here, but that's one of those things that we're really passionate about, is that your advice needs to be very unique to you. So if you're taking just general advice from Google and trying to apply it to you, that's sometimes riskier because you're not really getting something that's unique to your needs.
Sometimes I wonder where these rules come from. This 100 minus your age thing, it's almost like it's being parroted by, reporters who last week were covering the city council and today are writing a financial story, and it really doesn't make any sense. If you think about the assumption here is that stocks are risky, bonds are safe. Well, let's go back a couple of years and look at what happened in the rising interest rate environment in 2022 and 2023.
Yes.
Bonds got hammered, and bonds are not necessarily an analogy for safe. They're not equated to safe. Bond prices do go down, and that was a rude awakening for a lot of people. So let's go back and talk a little bit about this, because I first of all want to say that I don't know where these rules come from, but this falls into the category of rules of dumb. It does not make any sense. It's a cool thing to put on TikTok or something like that. It's really cool for that to be a catchphrase, 100 minus your age. And I think there is this attempt to simplify the complex.
That's what I was just thinking, was when you try to take a concept that would apply to everybody, it's an oversimplification. There's more than just stocks and bonds anyway. There are other asset classes that aren't even considered in this rule, and it's really not talking about the true problem in retirement, which isn't about your allocation, it's about your income.
Right.
And it's completely negating that altogether.
And Teresa, when you take a look at someone who is approaching retirement and they've got $3.2 million of net worth, now that's not necessarily investable assets, but they've got $3.2 million of net worth. They're worried about a market downturn. I think that diversification is the number one thing that we've got to talk about. Obviously, there's stocks and bonds, but there's also, when you're approaching retirement, there is a consideration of annuities. There's a consideration of alternative investments like real estate and things of that nature. There's a lot more than just stocks and bonds out there, but we've kind of been almost, tunnel visioned into thinking about stocks and bonds because that's what's in 401k plans.
And it's also what's advertised about a lot. When
Yes.
you're looking, when you're getting commercials on TV, they talk about bonds and stocks, but they don't ever really get into these others, partly because those products can be very complex. And if you don't have somebody coaching you through the purchase and the application of those, it can derail you quickly. So you're not really getting educated about those as an investor.
And I think also inherent in Jim's question is a focus on volatility in the market as opposed to the need for retirement income. Retirement is not an asset problem, it's an income problem. And that's really where your focus, Jim, should be, is how much income do I need? How much income do I want? And what is the strategy that you're going to withdraw that income from your portfolio? That has way more to do with the outcome of your overall retirement as opposed to what allocation you particularly have.
And market volatility is a concern in retirement, but it's only one of the three big ones. And,
Yes.
and I'd say even a fourth one on top of that. You've got market volatility, but you've got longevity risk. What if you live to be 9,500, which is more likely nowadays than it used to be? And then you also have inflation risk. We are all aware of that right now. We've had a lot of increases in prices over the last few years. If your plan's not accounting for that, then you're going to be in trouble there. And then I'm going to add a fourth is long-term care.
That's right. You're absolutely correct. Let's go back to this market volatility thing. This is kind of what Jim is alluding to. We've got a graphic for you to take a look at. If you're tuning in on the radio, you might go to our Facebook page and check out this graphic. But what you see here on the blue side of the graphic is the growth phase of your investments. And then on the red side is the income distribution. That yellow box in the middle is what we would call the risk zone of retirement, or the red zone. If you want to make the analogy to a football team or a football game, that last 20 yards, you play the game differently than you do anywhere else on the field because you've got to score. And the field is just different down there. You have less room to maneuver. Same is true as you're approaching retirement. You've got to be preparing your overall portfolio for distribution of income and be in a situation where if the market does fall, that you're not figuring out, okay, how far do I have to put off my retirement? We saw a lot of people do that in the past.
And I think a lot of people, they think, okay, I need to get super safe. I need to bring down the risk because I'm approaching retirement. What we would say is you need to get super granular about your plan and making sure you funded your plan in a way that the market volatility is not going to derail you in that red zone.
You know, you mentioned being super safe. I think safe is a relative term. Safe is one of those things that is in the eye of the beholder. Pardon me. But the key here is that you have different kind of risk. You have market risk, but you also have interest rate risk, and you have inflation risk. The only two asset classes that historically have kept people ahead of inflation are equities and real estate. Now, both of those can be volatile at times. So we've seen the volatility of real estate get impacted by the rise in interest rates. We all know that equities don't grow to the sky. There is volatility there, and we're enjoying a really good market right now. But I think that the time will come where we will see volatility come back into the market. You have to be prepared from a strategy standpoint as opposed to just being either in stocks or bonds. It's not quite that simple.
And I think that's why I love the way that we do this and that we do this flooring and bucketing strategy. A lot of people say they do it, but it's not exactly the same as what we're talking about. What we look at when we're meeting with clients is we ask them, like you said earlier, what income do you need? What's your timeline? When are you going to need it and how much? And we cover that with guaranteed products because the reality is your bills don't change just because there's a recession. We've got to make sure those are covered first. And then we take the rest of your assets and we time segment those based on when you need them. So we can take risks where we need to, where you've got time for them, but we don't take risks on things you're going to need sooner.
Congratulations to Jim from Rogers. His question is the question of the week here at the Get Ready for the Future show. All you have to do, Jim, is to email us to claim your free tumbler. The Get Ready for the Future show branded tumbler is absolutely yours. All you have to do is email us at show@getreadyforthefuture.com to claim your tumbler. And you too can be a winner on the Get Ready for the Future show. If you will send us in a question, you too could actually have your question identified as the question of the week and get a free tumbler. All right, let's move on. Little Rock is our next location for our question. This comes from Dontel in Little Rock. After watching the debate and some subsequential coverage, I'm worried about a recession after the election. What can I do to prepare myself for the outcome of the election, and how should I adjust my investments? Dontel, thank you for that question. Teresa, when you think about investments, everybody wants to equate that to the here and now of politics. Mm-hmm. But history tells us that that's really not a solid connection.
Yes, and we know historical performance is not indicative of future performance, but if we look at the patterns that we've seen in the past, the market actually doesn't care about the election other than that it's over. While it's going, there's a lot of volatility, and I think some of that probably is driven by investors panicking.
Yes.
But once it's over with, it seems to not really matter who won.
You know, we had the assassination attempt on former President Trump. Can you imagine if that had happened, not on the weekend, but during the week? Can you imagine what the market would have reacted, how they would have reacted to that immediate, question of, oh, is he okay, or whatever the case may be? The market would have probably been very volatile because that was a volatile situation. Yes. Not making any political aspersions about it one way or the other, but that's how markets react.
Yes. Well, and I think people don't realize that the market is affected by investor behavior.
Sure.
And so when something happens, and especially if it had ended differently, that could have created some short-term volatility. But the key is short-term.
We like pictures around here, so let's go to another graphic about this issue. If you take a look at the graphic, it's really just solidifying exactly what Teresa says. If you look at all the election years that have happened, as far as what happened post an election, then you see that the S&P 500 historically from 1952 through 2022, it's had a pretty even return. Now, it's different based on who wins the election, but I think you're right, Teresa. What the markets mostly want is, number one, for it to be over, and then secondly, markets, interestingly enough, like gridlock. They like this checks and balances that the founding fathers set up, and I think that's one of the things that kind of keeps things from going off the rails too far. That oftentimes when you have a incumbent in the White House of one party, you have the Congress controlled by another party, or at least enough of Congress to block, just this
someone
wholesale
from just steamrolling.
Steamroll their ideas and what have you. So clearly, I think that's an issue. I think also, Dontel, recessions are just like anything else. This too shall pass. If we have a recession, it's not the end of the world. I fear that we're almost in this mode now that we've been looking for a recession for, 2 or 3 years. Everybody's been on edge about recession. But when you're on edge about it, fear goes up. And so when all of a sudden somebody says, okay, we're in a recession,
we're already in it by the time they call it.
Yes, and panic ensues and all of that type of thing. And that's just not productive because you have to have a long-term vision.
And if you look at the progression of recessions over history, they've become shorter and shorter with each cycle. If you look back to 2008 even, it was about 18 months. It wasn't pretty, but it was over very quickly. So there's no need to just panic. Now, what I would ask you, though, Dontel, is have you got a plan or just a bunch of investments? If you just have a bunch of investments, it may be time to get with your advisor and verify that you're on track with your plan. But you certainly don't want to react and sell if the market dips, regardless of the cause.
I mentioned a little bit earlier that, pundits have been looking for a recession for a good year to 2 years. They've been calling, most of them have been calling for a recession. Oh, it's just going to happen. It's just a matter of time.
Yes.
Well, let's take a look. In the last year, the S&P 500's up about 27, 28%. The Russell 1000 is up almost 40%. So you can't call these things. No one out there has a crystal ball. I got one guy that has been right this time. He thinks he's got a crystal ball, but I got news for him. He doesn't have a crystal ball. Just because he's been right this time doesn't mean that he will be right from this point forward. I think what you've got to do is you've got to think about the next 20 to 30 years. If Dontel is nearing retirement, which I would assume based on his question that he is, he's got to be thinking about over the next 20 or 30 years, how do I be sure that a few things happen? And we alluded to this in the previous question. One is, how do I be sure that I'm going to have regular, predictable, dependable income coming to me for the rest of my life? That is an essential question. Sometimes we major on the minor things. Well, dependable income is a major thing. That ought to be first and foremost in Dontel's mind. Secondly, I think Dontel needs to be concerned about how do I get some increases in my income over time? Because whether a recession happens or not, one thing that we do know is that prices are going to increase. Even if we don't have a high inflationary environment, prices have steadily increased throughout history. Yes. And we will continue to see that. And that's a big vulnerability in retirement.
Yes. And I also think we don't want to ignore those that feel like maybe they haven't gotten prepared, because sometimes that question comes from a place where you feel like I can't afford to lose any money. But if you're several years out from retirement and you've got some time, this is a time, if you think a recession is coming and one happens, there's an opportunity in that for you to really throw some investments together and get some extra growth out of those. If the market's down and you can increase your contributions, that's going to pay later on when the market does recover, if you've got the opportunity to do that.
I always love taking the opportunity to talk about my first recession. My first scare in the market was I just started investing. I was not even a financial advisor at this point. It's back in 1987. I just opened up a mutual fund, and I was putting money into that mutual fund. And then along came Black Monday, and the market fell the most that the market had fell ever. I want to say it was 25 or 26%, something like that, in a single day.
Ooh, that would be painful to watch.
Scared the bejeebies out of me. I'm like, because the money
you
I
just got started and all your money's gone.
Well, and yes, and I'd put this money into this thing, and I wasn't wealthy by any stretch of the imagination back then, and so it was all I had. And so I called my advisor and I said, what do I do? He goes, hey, wait, let me ask you a question. Was that mutual fund a good buy when you got it? And I went, I guess so. And he said, well, it's an even better buy now. Buy some more. And, it changed my whole thinking about that. Now, Dontel might not be, young and trying to accumulate money, but recessions are, my point here is that nobody even thinks about Black Monday in 1987. That it's
I
just
have to
not
tell you,
even.
If I didn't work in this industry, I wouldn't even know what you were
wouldn't even know what I
referencing.
was talking about, right? So, things that we tend to focus on tend to be non-issues. They are headline grabbing, they're attention grabbing, they're shiny objects, if you will, but they are not necessarily impactful to the outcome of your retirement. And I'm just a bottom line guy. I want to know what the outcome needs to be and what's going to affect that outcome. There's a lot of things that affect the outcome more so than a temporary
arbitrary
recession coming down the pike.
And we don't want to negate how they feel. We understand that it's very frustrating to see your balance dip. I'm there. I got started later because I joined this industry later. I wasn't educated about this. And so I understand when I see my balance dip, that there's even with me, there's a moment of like, oh, but then I have to remember my why. I have to remember my plan. And that's why I'm so passionate about people having a plan, because if you have one, you can go back to that and go, okay, we knew this was going to happen. We planned for this. It's okay.
Right. Absolutely. Okay. If you are thinking about retirement, there is an important document that you absolutely have to have. It is called the 7 Steps to Financial Independence. And you can download that if you just text the word STEPS, STEPS, to 501-381-5228, or you can go to our website, getreadyforthefuture.com and /steps, getreadyforthefuture.com /steps, to download that document right now. And it's a great guide. It's not the end all be all, but it gives you the focus that you need to go down this journey. I think that's where a lot of people really err. There's so much noise out there. There's so much information there's no context for it. This is a context piece.
And I think it's overwhelming. When you feel like you don't have it all together already, and then you go looking for advice online, you're going to find 6,000 websites that probably disagree with each other. Whereas this document, I love the way that we've put this together because it is action items. It's things that you can do. And it also kind of gives you an idea of whether you need to be in to see an advisor or if you need to take care of some other things first.
Absolutely. All right, let's move on. Hope from our email box inbox says, I own a business and I am 56 years old. I don't plan to retire anytime in the very near future, but I know I'd be foolish not to start thinking about it. What are the things that you'd recommend as financial advisors that that I make sure are in the plan for my business as I near retirement? Are there any tax-efficient strategies for transferring ownership of my business? Hope, thank you very much for that. This is kind of where we live and breathe as business owners here at GenWealth. This is always an issue or a subject of discussion. So, Hope, let's talk a little bit about this. There are retirement programs that you need to be thinking about. If you don't have this set up in your business right now, there are a couple of retirement programs that you might want to consider setting up. And it sounds like maybe Hope has just a few employees or maybe not even any employees.
Right.
So let's talk about what her options are.
I think the first, the simplest ones are to do what's called either a simple IRA or a SEP IRA. Those are both small business employer plans that you can implement at a really low cost, typically for the employer.
And let's differentiate. A simple program is best if you have a good number of employees.
Yes. If you have 1099 employees, that SEP option is great because those aren't considered true employees. So with the simple IRA, you do have a match as an employer. So if you have employees, it is a better option because they have to have some skin in the game first. With the simple IRA, anyone who's an employee can defer up to the limit, but then you as the employer, you're matching 3%, up to 3% on that.
Let's talk about how that actually works because number one, there is a tax credit for setting up a retirement program. Most business owners aren't even aware of that. Most CPAs that work with business owners don't really even tell them about that. So there is a tax credit for setting up a retirement program. Secondly, that match may cause people to go, oh, that sounds expensive, but it's really not that expensive. Let's walk through that.
It's less than you would think about. And I've had this conversation with a lot of business owners when I explain to them, like, show me what your total payroll is for the year. And then I go through and I say, okay, 3% of that is X number of dollars. They usually will go, oh, that's manageable, especially because it's tax deductible. You get to take it off of your profit and you're not paying taxes on it. And it allows you as the owner to fully fund that and really drive some savings for yourself, which, by the way, lowers your individual taxable income.
And if you think about that total income number and the 3% calculation there, that assumes that everyone on your payroll participates.
And puts in the full 3% themselves or more.
That's right. If they don't do either of those things, then you don't have an obligation for that particular employee. So what you're looking at is if you take that payroll base and multiply it by 3%, that is your maximum liability on the simple program.
Correct. And it doesn't require a lot of regulation. Some employers, when they're thinking about plans, they're thinking of 401ks, and there are a lot of rules and regulations and documents you have to file. The simple IRA just doesn't have those. It's intended to be simple. Now, if you don't have employees, a SEP may be the better option because you can put up to a percentage of your profit into it, as opposed to it being limited by, I think it's 16,000 now for the simple. It changes pretty regularly, about annually lately, that you can put in from your own payroll. The SEP, if you're incorporated, you can put up to 25% of your net profit, or if you're not incorporated, say you're a sole proprietor, you can put up to 20. So you can actually put a lot more in if you have a higher profit business. So those are two options there that are pretty basic that just about anybody can do.
Let's talk about those that have a business that have a lot of income in that business, though. Maybe a sole proprietor. I think about real estate agents, doctors, lawyers, folks like that have the potential for high income, they need to really analyze the benefits and the cost of a defined benefit plan. Now, that gives you the maximum amount that you can contribute out of all the retirement plans, because it is not a defined contribution plan in that they're calculating a percentage of your income or anything of that nature. The defined benefit plan calculates how much money do you need in this plan over time to produce a defined benefit at retirement. That's where it gets its name. Now, this provides a huge tax benefit to those that are self-employed like that, but it could be cost prohibitive because there is a lot of administration to this. We work with some folks that have defined benefit plans. They are highly, highly beneficial to those folks. Even though they are costly to implement, they get way more tax savings than what it costs, and they're building money for their retirement. So in a few cases, if you have a very highly profitable business, then a defined benefit plan could be something that you could look at. She also asked about, is there a tax efficient way to transfer ownership of the business? And this is going to get in the weeds just a little bit. But there are in turn, and I would say, don't take this show as the sole source of information on this. Use this show, what we're about to tell you in this area, to give you a lead to go talk to your tax advisor, go talk to your attorney about this. But when you're selling a business, it's a complex situation. You could have an asset sale, or you could have the sale of goodwill. One of the two, depending on how you structure that, or you could have a sale of both of those things. And the way that that's structured really depends on how you're going to get income, whether it's going to be taxed at a capital gain tax rate or at an ordinary income tax rate. Also, whether you get written a check all at one time or you spread that out over time. There is certain ways that attorneys and CPAs can help to counsel you on that so that you look at your options and you don't make a mistake. Teresa, to kind of circle back to the big picture on this, what I really love about Hope's question is I see a lot of entrepreneurs just basically using their business just to make a living as opposed to funding their financial independence.
Yes, and there's one other thing that we didn't have listed here that I also want to bring up when it comes to business owners that I often talk to people about. I've had people who have run a business that is mostly analytical. Their brain is the business, and they get ready to retire, and what they have done for so many years is they've hidden from taxes for so long that they're about to retire with a Social Security benefit that's not really helpful.
Yes.
And so another thing, I know you and Janet have talked openly about this, that when I first joined the team, you guys were taking home a pittance of a salary.
That's because that's all we had.
Yes. And so as the business has grown, instead of continuing that and then using, the member distributions and things, which if you're a business owner, you know what I'm talking about, it's tax advantaged. But if you're doing that over the long term, you're setting yourself up to have $800 Social Security benefit. And if you're used to living off of $150,000 a year income, you better have some assets.
Yeah, the Social Security thing is something that a lot of people think they're somehow beating the government on this or whatever by having a low salary. And by the way, that's a red flag for the IRS.
Yes.
A lot of times with business owners, they have a low salary and then they take the distributions which are not subject to the FICA tax. Well, that really bites you in the rear end when you get to retirement age, because you have this small amount of Social Security, and if you haven't taken those distributions and invested those in the right way, then you certainly are hurting yourself from a retirement income standpoint. And that's a big issue for a lot of business owners. If you'd like to talk about that, we stand ready to help you with that here at GenWealth Financial Advisors. You can absolutely give us a call. Reach out to us on our website, info@getreadyforthefuture.com. We would love to set up a meeting with you to talk more about that. All right, let's go to Jay in Fayetteville for our final question of the day. Jay writes, I'm 55, originally from Texas, but I've worked overseas most of my life until now. I have $1 million saved and am ready for retirement. Congratulations, Jay. That's a good deal. My only concern is soaring inflation. Is this enough to retire comfortably? Well, like a lot of things, Jay, our answer is it depends.
Depends.
That's right. It does. And so I would say, Teresa, we have people who come into GenWealth all the time that have $1 million saved for retirement, and that plus their Social Security, we create a really nice retirement program for them.
Yes.
But a lot of it depends on how much income that they're used to having come into their household and how much they need to have when they retire.
I think for those that are allergic to debt is the phrase that I use, those that have, very little income need, you don't even necessarily need $1 million in assets to retire. It depends on your circumstances. But if you have a high income need, then that is going to be our first question we've got to answer. How are we going to take care of your income need? If we're able to take care of your income need and then you still got assets to cover that bucketing part of the strategy, the future inflation adjustments, then we're not going to be as concerned. But if we take those funds and we determine how much you're going to need for your income to guarantee that, and there's not a lot left over, then I would say you're not ready yet.
Yeah, I think how much Social Security is in store for I said this was Jay.
It's actually Jay. I wasn't
going to
correct
Joy.
you.
Thank you. Sorry about that. Joy from Fayetteville. How much Social Security does she have banked? What does that look like at the various ages that you can take that? You can take it as early as 62. Full retirement age these days for most folks is 67, or you could delay until 70. Here's the complex thing about what Joy is talking about. She's 55 years old. The first concern that I have is that you're retiring early. The second concern that I have right behind that is that she is female, and females tend to live a long life in retirement. And so you've got this longevity issue that we've talked about a little bit on the show today. We don't know whether Joy is married and whether her spouse, if she has one, has a Social Security benefit, but that figures into the equation as well. The other issue, I think, is whether there is a pension plan in play here. Did you work during your working years for a company that's going to provide you with a defined benefit, which is that defined benefit program that we talked about a little bit earlier? Most people call that a pension. If you have pension and Social Security, that's going to help in terms of longevity. But I think you have to, first of all, approach what the income gap is once you add up pension, Social Security against your retirement income needs.
Well, and understanding, again, with her being 55, we've got at least 7 years before you can touch Social Security, at least 4.5 years before you can touch IRA assets. So, and then I think 10 years before health insurance is an option. So we're going to have an extended period of time where there will be a gap regardless of assets.
This really points out something that I call the rubber band analogy. If you think about a rubber band and you stretch that rubber band out, it puts tension on that rubber band. Well, when you retire, let's say at 60 or 65, you've stretched the rubber band a certain amount. If you retire at 55, now that rubber band is stretched to the max. You're now going, okay, how am I going to cover this gap between 59 and a half and 55 to get me to my qualified money? And how do I make that money last a long time? So Joy really has a couple of good stiff things as far as roadblocks ahead of her that she's going to have to overcome. The longevity issue and just the survivability of your assets, come what may. Who knows what's going on down the road? How Joy navigates around that is going to be critical to the outcome that she has.
Yes, and I think there are options that you have to access the qualified money in advance, depending on what options she has available there might help her out. And like you said, with a lot of pension programs, they include health insurance. So there's a lot of variables, Joy, that we would need to understand to say whether you're ready or not. But in general, it's always important to understand all of those pieces before you pull the trigger.
You heard the bell. That is a signal that it is time for us to talk a little bit about our final thoughts. And Teresa, I'll do something just outlandish and open the mic for your random thoughts.
That's a dangerous proposition for him, I'm sure. No, I would say just like anything, you are unique. Your needs are unique. So it's great to get some good concepts and education through this program and other resources that we have. But the reality is your advice needs to be specific to your circumstances. So make sure that you're not just falling prey to whatever's out on Google for you today and taking time to understand your specific picture and getting the advice that's right for you.
Teresa, I believe that summer is travel time and everybody's going here, there, and yon. And I will guarantee you almost every trip that happens is mapped out, is planned out ahead of time. That there's been some planning, there's been some sitting down and going, okay, we're going to stop here, we're going to eat lunch here, we're going to overnight in this particular town or city or whatever the case may be. People spend probably a good amount of time. It varies with each family, but they spend a good amount of time working on that family trip, that vacation, whatever the case may be. My final thought is you need to be spending time with your financial advisor, sitting down and going through what your plan is for providing income for you that is regular, predictable, dependable, and inflation adjusted for the rest of your life, and then providing income for yourself that is over and above what your basic needs are so you can enjoy retirement and really realize what we're talking about when it comes to financial independence. That plan can be yours. Contact us here at GenWealth Financial Advisors. That's going to do it for the show for this week. We thank you very much for joining us here at GenWealth and on the Get Ready for the Future show. If you've got questions, reach out to us. We're always available to you. Have a great week.
The GenWealth Financial Team is available to you 24/7 at info@getreadyforthefuture.com or call our offices at 866-653-PLAN. That's 866-653-7526. You should personally consult a financial advisor before making any investment, and no strategy can assure success. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Independent Advisor Alliance. Independent Advisor Alliance and GenWealth Financial Advisors are separate entities from LPL Financial.